With great pleasure, let me now bring on board Hugh Young, Managing Director of Aberdeen Asset Management. Just a background of Aberdeen Asset Management: they manage assets of nearly $2 billion plus in India. They are active in India for over a decade, and various global rating agencies have rated Aberdeen funds as star funds. Hugh, what a delight to have you back on ET Now. Thank you for joining us. Hugh, let me take the clock back. Last time when I interacted with you on this forum, you were a big bull on India. You were a believer of the India story. But given the way how macros and micros have moved for Indian markets in last 2 quarters, are you a worried investor now?
Well, we're still bullish long-term on India, but I'm afraid India has done its best to shoot itself in the foot, certainly from a government level. So there have been some big issues raised over the last couple of quarters, but we haven't altered our investments in the underlying companies. The underlying companies that we hold in India, we're still very, very comfortable with. It's just been very disappointing as a great supporter and lover of the country that the policy making has been poor and the decisions have been frankly all over the place. Decisions made, decisions reversed, lots of politicking going on, which does unsettle investors. Fortunately, we do know India well and we know the companies well. So we're sticking with it, but I think many of our peers in the asset management industry are sitting on the sidelines and rather disappointed with what's going on.
Hi, morning. So from a global investor point of view, what are the key policy reforms that you would want to see immediate action taken by the government when it comes to investment climate in India?
In a sense, one's not looking for immediate action tomorrow or anything like that. I think what one's looking for is steady, long-term, focused action by the government and policies that are well thought through and implemented. So one's not looking for a big rush on the policy front. I mean, I think that's where, in a sense, some of the issues are coming. Decisions are quickly made and then reversed. I think one has to plan a lot more, continue with the steady opening of markets, steady but not headlong opening of markets. There have been other issues raised. Probably the key issue that's worrying investors at the moment, and it crops up every few years, has been the status of double tax treaties with the likes of Mauritius, and whether that affects some of the foreign asset managers who've channeled their funds through regimes like Mauritius or indeed like Singapore. That's been one of the big issues, so some clarity on that front once and for all would be very useful. But that's been a perennial issue that really does worry foreign investors in India.
So from Aberdeen's perspective, do you think you have got enough clarity on the GAR issue, or that issue is still confusing you?
I think it still confuses somewhat. So I think clarity on a variety of issues has not been at all present in India, and in part that's due to weakness of government, when it's due to conflicting political pressures that have disturbed us, albeit to a lesser extent given our knowledge of India, but it's disturbed many investors, and I think has put investors off India. So you have seen quite a flow of funds by foreigners out of India. Admittedly, one has to remember that India has performed exceptionally well over the years. If you look over a longer term period, it has been one of the better performing stock markets in the region. And if you look at valuations, even after India's relatively disappointing performance over the last 18 months or so, the valuations in India are still among the more expensive in the region.
So Hugh, some of the stocks and companies that you've tracked or liked, Bharti Airtel, the telecom biggie, and do you think now with the 4G license as well in the pipeline, this is going to be somewhat of a game changer for the company and therefore add value to the shareholders?
We hope so. It's been a long wait there. That's been a more disappointing investment, certainly over the last few years. So we hope that that's a bit of a ray of light for them. So keeping our fingers crossed, I think.
So at 326, are you looking at adding more Bharti, or if Bharti goes to 400, you would be looking at selling Bharti?
Well, I don't think we're not terribly price sensitive. I mean, I guess as far as Bharti is concerned, we've more been worried about some of their overseas ventures than we have what's going on in India. So we're still very much looking at those closely and what's going on in Africa. That's been our concern. And we're not, as far as prices are concerned, that's less of an issue. I think our concerns are far more to do with the overall quality of the business and whether it's the move into Africa is going to prove a profitable one or not.
So what's been your portfolio strategy of late at Aberdeen Asset Management? On every decline, are you buying your old favorites, HDFC, ICICI Bank, cement stocks, Hero Honda?
Yes, I'm afraid if you look at our portfolios, they're unchanged, certainly from when we last spoke, and pretty unchanged from a few years ago. So we still have all the same key investments. I mean, in the finance sector, yes, it is the HDFCs and ICICIs, stocks like Hero Honda, consumer exposure through the Unilevers, ITCs of this world, and IT exposure through the likes of TCS and Infosys. And we haven't changed our long-term views on those companies. Of course, from time to time, from year to year, one or other of them will have a slower period, a period of consolidation. But as far as we're concerned, we're investing in these companies really for the long term. And by that I mean on a 5-10 year view.
So if you get a redemption, which is one thing you will sell, and if you get inflows, which is one thing you would like to add?
Well, rather than give any names that we'd be buying, I think by and large we're happy if we see inflows. We're by and large happy topping up holdings across the board. Of course, on any specific day, we do look at prices. So if one of the 30 or 40 stocks that we hold has had a bad period through no fault of its own, just because it happens to be out of favour for reasons other than company-specific reasons, we'll happily top that up. And vice versa, if we have redemptions, we'd either redeem pro rata across the board or look specifically at which stocks have shot up because they happen to be flavour of the month. Again, providing the business remains unchanged and nothing has dramatically improved with the business. So it's very, very situational as far as redemptions and subscriptions are concerned.
Hugh, are you happy with your IT investments? That's TCS and Infosys, given the investment climate in the Western world and, of course, the currency fluctuations back home?
Yes, I mean, there is short-term concern. I think I was, in a sense, referring to that earlier. There will be years, or the odd year, where the companies in which we invest have a slow year or a year of consolidation, not necessarily through any fault of their own. And I certainly think that's the case for the IT sector. Nothing wrong with the likes of Infosys or TCS. But of course, if the world is slowing, their business will slow, and indeed it is. And you're right to worry about some of the currency translation effects. Yes, that is a concern. So it might mean a quieter year for their earnings in the current calendar year. But do we worry about that? No, not in particular, providing the business is still in good shape and is long-term competitive and is continuing to improve, which I think, despite the dramatic growth we've seen from that whole sector, I think the management of the companies have handled things as well as anyone would ever handle such growth.
Are you betting on any sunrise sectors in India?
No, we haven't added too many new positions. In fact, we've added very few new positions. We're constantly on the lookout for new ideas. Every fund manager gets excited about new ideas, which of course can be one of the dangers of our profession. And you don't look at what you already hold, which often is what is best to hold. So we've been trying more and more to focus on what we hold, make sure that everything is going on well within those companies, and subject to externalities, things are going well in the companies we hold. So not looking at anything particularly new to buy tomorrow.
Do you think Indian consumer stocks are now mature businesses? Valuations are looking stretched. Yes, there's a great consumption, underlying demand still which will persist in India. But from your perspective, it's too late now to buy the HUL, the ITC, the Britannias and the Colgates of the world?
They're not cheap, so that is one of our concerns. But again, looking through beyond the next year or two, I think it's still okay to be investing in such companies. We'd love them to be a lot cheaper, and we never enjoy paying price-earnings ratios up in some cases in the high 20s. I mean, in some cases, the likes of Nestle India, up in the 30s. These are not cheap valuations, but you are getting some great long-term businesses, and if you're patient, they'll pay dividends. I think that would be a case where, again, with cash coming in, it's not something we're passionate about adding to at the moment, given the valuations, but we're very comfortable sitting on the holdings.
Hugh, what about banks? The exposure to risky sectors like aviation, power, what have you, does that not worry you in the near term?
Yes, bank loan books always worry us wherever we look in the world. I mean, our large holding is fairly well insulated from that being HDFC and its mortgage book. So it would be the likes of ICICI that has had its ups and downs over the last few years. But we think they're keeping quite a close eye on their loan book, having got into difficulties a few years ago. So they've been pretty stringent for the last couple of years. But yes, these things are a concern to us, and it is one of the risks of the industry.
In last 5 years, HDFC has been a constant holding for you. Do you think HDFC will be a holding which you are likely to sell for next 5 years as well, because it's a great compounding machine, it's a great business, it grows at 20% every year?
Well, yes, ideally, and we'd love to say that with all our holdings, that we'll sit on them forever and a day. And I think we've held HDFC probably now for 10 years or maybe even more. It has been a great investment. Again, a bit like some of the consumer stocks, it's hard to argue it's the cheapest stock in India, but is it a great quality investment? Yes, it is, and we'd dearly like to be still holding it in 5 or 10 years' time, although you never can predict the future.
So, one word answer you before we wrap. A year ago when I interacted with you, you were bullish, but are you cautiously bullish now?
Far more caution now, so given what's going on at the government level, but at the company level as bullish as ever.
And what is your big bet for the year 2015? I'm not going to ask you for this year. Let me ask you for next 3 years.
I don't think we have any particular big bet. We like the balance of our India exposure within our India fund is nicely balanced with some great companies. Our Indian exposure within our regional Asian portfolios is around 12%, and that feels a very comfortable level given the potential of the country and, importantly, the potential of the companies. So no great predictions. Still not a cheap market, but it has some of the best companies within the region within it.